Now, introduction. We said capital expenditure like building, plants, fixtures and fittings do normally last for more than 1 year. It's obviously that possibly that what this asset may deteriorate with the passage of time due to its usage. There is therefore the need to recognize the loss in the value of non-current asset in the books of account. If this is not done, the value of non-current assets in the statement of financial position will be incorrectly stated. So if you buy an asset, as you make use of this asset in generating income for that business or benefit for that business, economic benefit for that business, the asset does not remain new. So there's what the asset loses value as you use it in generating economic benefit for the organization. That's what there's need for you to charge the amount that is being used up in the financial statement. So the process of recognizing the loss in the value of non-current assets as a result of using such asset is called depreciation. That's just an introduction. Now we have non-current assets. Example for non-current assets are what? They are tangible items that are held for use in the production or supply of goods or services for administrative purpose and are expected to be used during more than one period. Non-current assets are purchased to be used in the business for a long period of time. These are assets. These are things that you buy to be used for more than one accounting period in generating your economic benefit for the business. Example, we have plants and machinery. We have land and building, fixtures and fittings, motor vehicles, and so on and so forth. Now, what is depreciation in the first place? Depreciation is a systematic allocation of the depreciable amount of an asset over its useful life. That is, number of years it will be used. Depreciation is an expense to the business for using non-current assets to generate economic benefit. It is provided to spread the cost of using non-current asset over its useful life. Depreciation is not the fall of value of a non-current asset. This is the systematic allocation of what? Depreciable amount of an asset over its useful life. So what are we saying? Current asset, or this non-current asset we're talking about, or fixed asset we're talking about, they have a lifespan. This lifespan is what will be used in generating economic benefit for the business. Now, what are we doing? We're trying to allocate the amount that will be used up across its useful life. For example, if we buy, let's say, a plant and machinery for our business, and then we estimated that this machine will be used for, let's say, 10 years, it means its useful life will be 10 years. And then at the end of that 10th year, what should we expect to be the the value of that machine? That is, at the 10th year, let's assume we bought the machine of 10 million, and then at the 10th year, after 10 years, the machine will have a value of, let's say, 1 million. The 1 million that we are expecting the machine will be valued at is what we call the residual value or the scrap value. Now, the 10 years is the estimated useful life of the machine. So what are we doing? We are systematically allocating the depreciable amount of an asset over its useful life. As we will see in the definition of terms here. What is depreciable amount? Sorry. What is depreciable amount? What is depreciable amount? Depreciable amount, excuse me, let me make my slides to be visible. So depreciable amount, this is the cost of an asset for its value amount in case where a non-current asset is revalued during its life, less its what residual value. So as I was giving that example, I said, if the cost of the asset is 10 million, and then we expected that at the end of the 10th year that the machine will be used in the business, the value will be, let's say, 1 million. So the depreciable amount will be the cost of the machine minus the residual value or the scrap value. That is, the depreciable amount will be what? 10 million minus 1 million. That will give us 9 million. That is what we call depreciable amount. The residual value or the scrap value, this is what the expected disposal value of the asset after deducting disposal cost at the end of its expected useful life. We're looking at what are we going to get when we sell the machine after its useful life. That we call residual value. That means what you do is you have to consider what will be your disposal cost. What will be the cost in selling off this non-current asset? You take note of it before you now look at what you get. Then we have the useful life. This is what the period which the asset is expected to be available for use by the business entity. So take note of these three terms. The first one is depreciable amount, which is cost minus scrap value or residual value. We talk about residual value, that is the amount that the machine will be disposed of at the end of useful life. The useful life is the period in which the machine will be used in generating economic benefit for the business or for the business entity. Factors affecting the useful life of a non-current asset. Factors affecting useful life of a non-current asset. We have wear and tear. We have obsolescence. We have damage by accident. We have technological improvement. Now, let's look at them one after the other. Wear and tear. An asset. The asset's value or the asset, it's what begin to get older and older as a result of what as usage. Let's look at maybe you buy a brand new car, for instance. As you're driving the car continuously, there's what we call wear and tear. If we look at the tire, for instance, the tire will begin to the time become very old. The same thing with the asset. The asset will become older and older and older until it reaches what its disposable period of time. Is what is wearing and tearing as a result of usage. As you use the asset, the value reduces. The value becomes lower and lower with time. The next factor that affects the useful life of non-current asset is obsolescence or outdated or old-fashioned. When an asset becomes outdated, that means it must still be in a good condition, must still be usable, but because it's not longer used, it's no longer in vogue, it becomes what? An old-fashioned item. What no longer use it. So it will affect the useful life of an asset. For example, if we remember before the advent of computer, we were using typewriter. Typewriters were used in the olden days. But when the computer comes and printers, nobody make use of typewriter. They become what? Obsolescence. They become what? Outdated. Another one is damage by accident. An accident, useful life can be affected by what? Damage by accident. For example, if you buy, let's say, a motor vehicle, and then you estimate that the machine or the motor vehicle will be used for, let's say, 5 years. Let's say in the first year, you have an accident with that car, and the car is beyond repair. It has what? It has affected its useful life. So damage by accident affect the useful life of what? Of a non-current asset. Then the last one is what? Technological improvement. When there's an improvement in technology, people no longer look at old-fashioned things. They don't look at old technologies. Remember, let's look at our phones. When phone came, we're using button phones. We're using those 3310 Nokia and the rest of them, Gem and the rest of Samsung, Blueface, and the rest of them. But with the improvement in technology, people are using smartphones, they're using iPhones. Hmm? There's improvement in technology. People that has those techno, I mean, not techno, people that have those Nokia 3310, those Nokia might be useful, but they're still okay, functional, but because of what? There's an improvement in technology. They'll just dump those phones and then begin to use what is obtainable, what is involved. So these are the factors that affect the life of what? Useful life of non-current asset. Now, reason for providing depreciation. Why must we provide depreciation? One, prudence concept. The prudent concept will be overstated. I mean, the profit will be overstated if that depreciation is not charged against income during an accounting period. Yes, because you'll be reporting that what you have X profit within that period. And if you don't charge depreciation, the profit will be what will be higher. Because depreciation is what is an excluded as an expense in the profit and loss account. But if you don't charge it, it means what? Your profit will be overstated, will be higher than what it ought to be. That's the first reason. Then number two reason is matching concept. Depreciation is an expense and must be what? Properly matched against income generated during what? During a financial year. Remember our accounting concept, principle and concept. We say it what is so-called matching concept. You bring the income and then the expense that they use in generating that income, and then what? Report them in the same period. So we have to what? Match depreciation as an expense when reporting for that financial year, because that asset that is used in generating what? Income in that year. So you have to match the expense with the income generated for that period. Method of depreciation. So we have the straight line method or fixed installment method, or we call it equal installment method. Then we have reducing balance method or diminishing balance method. We have sum of the year digits method. We have units of output method. We have revaluation method. We have machine hour method. We have depletion of units method. These are the various methods of depreciation. These are what? The various methods of calculating depreciation. Now, for the sake of this class, we will dwell on the first two, that is the straight line method and the reducing balance method, or we call it diminishing balance method. We'll look at these two for the sake of this class. Now, let's look at the straight line method. According to this method, we said depreciation is what calculated as what? As fixed percentage on the cost. It is mostly used for non-current assets such as what? Fixtures and fittings, which is consistently used over what? Its useful life. Under this method, an equal amount of depreciation in each accounting period over the useful life of non-current asset. The depreciation amount is computed by what? Dividing the original costs of the non-current asset will now less the estimated residual value, what is the salvage value, and divide by what? divided by the useful life of the asset. This method can also be calculated using what? The following formula. Look at the formula here. Depreciation equal to cost minus residual value over the useful life. Remember, we say the cost is what? Cost is what you pay in buying or purchasing that asset, that non-current asset or that fixed asset. Why the residual value is the amount you estimated that you will recover when the asset is sold after its useful life. I would say useful life is what? Is the period that this machine will put to use in your business entity. So take note, cost minus residual value, or we call it scrap value, divided by what? Useful life. Now we have this simple illustration. We have this simple illustration, sorry. We have this simple illustration. Um, so we have this illustration. We said on January 1st, 2022, Haida Limited purchased a motor vehicle for 250 million pounds. The motor vehicle has an estimated useful life of 5 years with a salvage value of 5 million pounds. That is a simple question. And we said what? You are required to calculate the depreciation charge and cumulative depreciation for each of the year and show the net book value as at the end of 2026 accounting period using the straight line method. Now look at this question has everything we've talked about here. We have the cost of the machine here. We have the useful life, which is 5 years, and we have the scrap value or salvage value of 5 million pounds. Excuse me. Now, if you can see my screen, so this is what the solution. We want to calculate our annual depreciation for this business entity. And remember, we said what the formula is given by annual depreciation equals to cost minus residual value divided by useful life. So I said my cost from the question is what? Is 250 million pounds. Then we say the residual value is what? Is 5 million pounds. And we say useful life equals to what? Useful life is 5 years. The machine will be used, the motor vehicle will be used for 5 years. So to apply this, you now say 250 million divided by 5 million, which is the scrap value or residual value. Minus 5 million scrap value, then divided by 5 years. You get 49,000 pounds every year. It means that what? This machine will be reducing by 49,000, 49 million pounds every year for the 5 years. That is, every year the machine will be reduced by what? 49 million. Let's see how it will be shown in the account. Let's see how it will be shown in the account. Sorry, my mouse is giving a lot of problem. Let's see how it will be shown in the account. Um, this is how it will be shown in the account. Remember that we said what? We have the year here. We have the carried amount at start of the year. We have depreciation for the year. We have cumulative depreciation for that year. We have the carried amount at the end of the year. So we have this machine was bought in the year 2022, which is the first year. And what's the cost of that machine? The current amount that will be shown in the account would be what? It would be 250 million. I would say each year the machine will show we should be there will be what we show we charge for how much? 9 million every year. So this is what vision for the year is 149 million. So this accumulated is what is the one that you add it up. What am I saying? You add it up. So this is the first one. So there's nothing to add here. We remain 49. Now the carrying amount at the end of the year would be what? Your carrying amount minus your depreciation will give you your carrying amount at the end of the period. That is the cost of the asset less depreciation of the year. For the year, they'll give you what? Give you the carrying amount. That is 250 minus 49 million will give you 201 million. And then this carrying amount at the end of year one, which is 2022, becomes the opening balance or the carrying amount at the start of the year for the next year, which is year 2023. That is 201 million. So the same amount will be charged. That is 49 million. 49 million. Then to get this one is what? It's 49 million plus 49 million. That is will give you what? 98 million. That is this plus this, 38 million. You now say, okay, if you like, you can say 250 minus 98 million give you 152 million. You can say, okay, 201 million minus 49 million will give you 152 million. Now, this being the carrying amount at the end of the year 2023 becomes an opening or carrying amount at the start of the year 2024. Take note, we say that the opening balance or the closing balance for this year become an opening balance for the next year, of this coming year. So that's what we're doing here. This is 152 as a closing balance for 2023 becomes the opening balance for 2024, 152 million. Now, the same amount we charge of what? 49 million. When you subtract 49 million from 152, you get 103 million. This is the closing amount in 2024. Then this one becomes the closing and opening amount for 2025, which is what? 103 million. And then the same amount will be charged. That is 103 minus 49 will give you 54 million, being the carrying amount at the end of the year 2025. Now, this becomes the carrying amount at the start of 2026, which is the last year, because the machine will use for what? Since for 5 years. This is year 1, 2, 3, 4, 5. It means it will be sold in the year 2026, and the carrying amount at the start of that year is 54 million. Then when you subtract that amount for depreciation for that year is 49 million, you get 5 million as what? As the carrying amount at the end of the period. Now, for this depreciation that we have, accumulated depreciation is what? You add this plus this, you get this, This plus this, you get this, plus 49, you get this, plus 49, you get 245 million as what? Cumulative depreciation. So if you look at this, we said, note, in the example above, the cost of the non-current asset is what? 250 million, which is this very one. Depreciable amount is 245 million. That is this one now. The last figure is what? Under cumulative depreciation is what? 245 million. The residual value is what? Is 5 million. You can see it here. Then the useful life of the machine is what? Is 5 years, which is 1, 2, 3, 4, 5. And depreciation per year is what? 49 million. The current amount at the end of 2026 is what? Is equal to the residual value. Because we said at the end of the 5th year, the machine will have a value of 5 million. If you can see it, that's what we have here. 5 million we had here. Now, if we are reporting, for instance, we are reporting, let me just use farming. If you want to report, show how it would appear in, want to show how it will appear in the want to show how to appear in the P&L account. Let's say this is our P&L account, profit and loss account. Also, this is my P&L account. So for the first year, 2022, depreciation of motor vehicle will be, of course, this figure, 49 million. That is, it will be as what? As an expense, under expenses as what? 49 million. Then, if you're reporting for 2023, of course, because we say this what is equal installment. If you get the first installment, is the same amount you apply. Depreciation on machine will be the same 49 million. So it goes on and on till you reach the last date, which is what? The 2026. So what are we saying? That means when you're preparing your profit and loss account, remember that you have what? Depreciation of fixed asset. And for the year, which year are you reporting? Whichever year you're reporting, if you're reporting for 2022, your depreciation will be what? 49 million. If you're for 2023, the same amount, 2024, the same amount, 25, same amount. So if you're preparing account for 2022, you what? You will now have depreciation on motor vehicle, 49 million. You're done with that year. Then you come the following year, 2023, you're reporting for that 2023, what? You have depreciation on fixed asset or motor vehicle, you have what? The same amount as what? 49 million. Same thing with 2024, 2025, 2026. So it has what? It is equal installment. We have what? We said it is what? Equal installment. Now, that is under the P&L account. What about the balance sheet? What about the balance sheet? If you want to show it in the balance sheet, if you want to show it in the balance sheet, let me just undo this. I don't want to use arrow. Let me use just a line. This is my balance sheet, for instance. Let me use the vertical format, not this format. Let me use the vertical format. This is my balance sheet. This is my balance sheet. My balance sheet. So under the fixed assets, under fixed assets or non-current assets, fixed assets, of course, you're going to have motor vehicle. So we have the cost of the motor vehicle will be here. Sorry, let me just clean this. So the cost will be here. Now, accumulated depreciation will be here. Accumulated depreciation will be here. And then we have the net book value, NBV, will be here. That is, if you are reporting in the balance sheet or the statement of financial positions, that's how you record it. So if you're looking at 2022, for instance, so the cost of the machine is what? 200, the machine is what? 250 million. 250 million. How much is the depreciation for that year? Is what? It's 49 million. We now have 49 million. Then your net book value, that is the value of the machine as at December 31st of 2022, is what? Will be 210 million. 201 million, sorry. 201 million. That's how you report it. So in this case, you will use this figure as what? As your total non-current asset. You add in other asset. This one will close. So we close. This one you close. And this is what you will use to what? Add it to non-current asset. You add it to non-current asset. So that is how you report it in the balance sheet. When you come to 2023, you have, because of the asset, you can use 250 million. Then you subtract for 98 million as what? As your cumulative depreciation for the year. This one. Then you have an NBV of 152. You do it for each year. Depends on which year you are reporting. That's how you what? You treat them in the P&L account as well as the statement of financial position. Now let's go ahead and see. Now the next topic is what? The reducing balance method. So under this method of depreciation, the book value of a non-current asset at the beginning of the year is multiplied by a fixed percentage to determine what? The depreciation for the accounting year. This procedure is repeated in the subsequent accounting period so as to reduce the depreciable amount of the non-current asset to its residual value or to zero if the asset has no residual value. So what are we saying? Unlike the straight line method, this one, what you do is what? You charge a percentage of depreciation what? On the opening balance of the asset. Then when you subtract it, you charge it and then subtract the depreciation for the year, you have another closing balance, becomes an opening balance again, at the same rate. So it begins to what? The figure begin to reduce, called what? Reducing balance method. Let's look at it practically. We have the same question. On January 1st, 2022, John K. Limited purchased plant for 250 million. It is the policy of John K. Limited, forget about the name, to depreciate plant at 20% per annum. You are required to calculate carrying amount as at the end of 2026 accounting period using the reducing balance method. So we have the cost of the asset here, and we have our depreciation rate here, which is 20%. Let's look at how to treat it. So in this one, we have the year. The same thing we have there, we have carrying amount at the start of the year or beginning of the year. This is the what? Depreciation rate, which is given to us in the question here, 20%. It's here. Then we have depreciation for the year, that is for each year. Then we have our cumulative depreciation. Then we have the carrying amount at what? Carrying amount at the end of the year. Now, for the first year, we have 2022 as well, the first year. What is the cost of that machine? We say this what is 20 million or 250 million. Then 20% of it is what? That's 20 over 100 times 250 million. That's how to do it. You can use a calculator. You said 20% is 20 over 100 and you multiply by these costs on the carry amount of what? Of 250 million. 1, 2, 3, 1, 2, 3. You have 50 million. That is for year one. Year one, you have 50 million. Now, that's a 50 million. That's 250 million multiplied by 20% will give you 50 million. That is for that year. Now subtract 50 million from 250 million, you give you what? 200 million. Of course, since it's the first item here, I believe we show reward with the same thing as 50 million. Then this become the carry amount at the end of year. Now, in 2023, they become what? Becomes carry amount at the start of 2023. So you still multiply by what? Multiply 20% on this. That is 20% for this one, 20% over 100 multiply by 200 million. 200 million. Of course, to give you what? 40 million. You know, say, 200 million minus 40 million give you 160 million. That will give us what? Our carry amount at the end of 2023. Then it becomes our carry amount at the beginning of, or the start of 2024. 160. You see, maintain, you see, multiply what? The 20% of 160 is what? 32 million. Subtract that 2 million from 160 will give you what? Give you 128 million. This becomes our opening balance for 2025. 128 million. Multiply 20% on it, you get 25,600,000. We subtract this one from this place, you get 102,400,000. This becomes our what? Our opening balance for 2026. Then multiply 20% on it, you get 20,400,000. 480,000. Subtract 20,480,000 from this 102,400,000, you get 81,920,000 as what? As the carrying amount of the machine. That is what will be what? The value of the machine as at the year 2026. You can see it here. That's the value of the machine. Now, if you look at this one, it maintained what? It maintained the same rate, but the value amount is what? It multiplied the carrying amount, the opening carrying amount with what? With the same rate, and then it charges tuition for that year. Now, to get this is what? Is 40 plus, 50 plus 40 give you 90. 90 plus 32 give you 122. 122 plus 25, 600 give us 147, 600 plus 2480 give us 168, 80,000. That's how you get what? The accumulated depreciation. So in the same year, in the same way, if you want to show it in our books, when you show it in our books, you have, of course, you have your trading profit and loss account. That's you have your P&L account. Also, this is P&L account. This is P and L account. So when you have your expenses, under your expenses, of course, you have things like salaries and wages, you have things like insurance, you have things like advertisement, you have things like rent, lighting, and these are what? These are expenses. Then under you have what? You have depreciation. Depreciation. Now, if you're preparing account for the first year, which is 2022, depreciation amount will be what? Depreciation on motor vehicle. So the MV will be, of course, it will be the first amount here. We have it as what? As 50 million. That will be treated as what? As an expense in the account. Sorry if I pay 50 million as what? As expense. But if you're looking at 2023, the amount will now be what? Will now be 40 million. That's for 2022. This is 2022. Now for 2023, you will use this figure. 2024, you use this figure. 25, you use this figure. 26, you use this figure. So if you look at it, what? The amount of tuition is what? Is reducing. That's what they call it, what? Reducing balance method. It is reducing with what? With time. The first year charges high depreciation. Why is that so? Because it is believed the asset is new. It will what? It will be used to it. You use it for to generate optimal benefits. You will not have a problem with the asset because you believe it's new. So you charge what? You charge higher. Then in the subsequent years, what? There will be repairs. There will be downtown. I mean, there will be maybe you have a problem with the machines. Maybe you need to repair. You want to fix the machine. You have breakdown of the machines. So that's why we charge it lesser and lesser. As the machine getting older, the depreciation rate is what? Is the amount is what? Is reducing with the years of the machine. So the first year of the machine is what? Is always charged higher than subsequent years. Now, Sometimes you may not be given the what do you call it, the rates to charge. You may not be given the rate to charge. You'll be given information only. So there's need for you to what, to calculate the rate of depreciation. So we said where the percentage rate is not given, this can be calculated by using what, a formula provided the residual value, the cost, and the estimated useful life of the non-current asset is known. So if you have the cost of the machine is given, we have the residual value given, and we have the useful life of the machine, you can determine the rate of depreciation. Now, the formula that can be used to derive the percentage depreciation rate per annum to write down the asset to the residual value, or zero where the asset has no residual value, is given by what? The rate is what? 1 minus n into the root of residual value divided by cost of assets. 1 minus n root of residual value divided by cost of asset, where n is what? Estimated useful life. Remember, I've explained what is residual value. Remember, I've talked about the cost of the machine. The residual value is what we say is the value at the end of the useful life. That is what will be realized at the end of the machine's life. If the machine is going to be used for 5 years, at the end of the 5th year, if we sell that machine, how much or what is the worth of that machine? We call it what? Residual value or scrap value. The cost of the machine is what? It is how much did you buy this machine? The cost includes the what you paid and then what you paid for. I mean, bringing the machine into your premises, your carrying cost of the machine. So when you have this information, you'll be able to calculate the rate of depreciation to be used when you're using the what? When you're using the reducing balance method or diminishing method. Now we have this illustration. A non-current asset costs 1 million and its estimated value is 200,000. At the end of year 5, the reducing balance depreciation rate is calculated as follows. So we have the what? The cost of the machine, we have the residual value, and we have what? The useful life of the machine of what? 5 years. So applying our formula, we say rate equals to what? 1 minus n over residual value over cost, where we say n is the estimated useful life. So 1 minus 5 root of the residual value was what? Which is 200,000 divided by the cost of the machine, which is 1 million. When you divide 200,000 by 1 million, you get 0.2. 0.2. You now calculate, to say, okay, fifth root 0.2. That means there's a function in the calculator to use. I said fifth root 0.2 give you what? 0.7248. You now said 1 minus what you got from here, and they'll give you what? 0.2752 or 27.52%. That is what? That is the rate to be used to what? To charge or to compute our depreciation when we're using the word reducing balance method. That's how to calculate the rate. Take note, we said it has a formula. The formula is what? 1 minus n root of residual value over cost. And then we know what cost is, we know what is our residual value is, and then we know what is our n, which is what? The useful life of the machine. And we say, first of all, what do? If you don't, you have to what? Divide it first. The one in the division, in the root, you have to what? Divide it first. You have to divide it first. First of all, you divide. This one is like this. You divide it first. When you divide 200 by 1 million, you get 0.2. Then we now find what is fifth root 0.2. Of course, calculator will give you that you have 0.7248. You now say 1 minus what you got here, and then you get what? 0.2752. 27.52. Then if you multiply by 100, it gives you what? 27.52 as your what? As your rate of computing your depreciation. Any question from anybody on depreciation of fixed asset? Any question? Mr. Adeoye, are you there? Scholar, are you there?
I'm there. I think
Any questions so far?
none for now, sir. Still okay.
All right. So
Seems to be straightforward.
that is how. Hello?
I said I'm getting it.
All right. So that is how you treat depreciation of fixed asset, non-current asset. It can be any asset. These are what this based on this method, that's what we use. So it depends on which method the company or the business decided to use. There's so many other methods, but for this course, I say we're going to look at these two, the straight line method and then the reducing balance method. So if there's no question, and then we say what on that we have the let's look at the theory of these other ones. So let me just continue with this. We have okay, we have the unit of production method. Let's look at them. I wanted to use two, but let's continue so that we have a better knowledge of it. Now we say unit of production method. Under the method, the depreciation expense is equal by what? Computing by a company is contingent on the what? Actual users of the machine. So we want to know how much units was produced. The more units you produce, the more depreciation you charge. Therefore, the amount of depreciation recorded is variable and is what directly dependent on what? How much the fixed asset or the PP and E, that is property, plant, and equipment was utilized rather than what other depreciation method, such as straight line method or specific depreciation method. So what we're saying is what? It depends on usage. This method depends on usage. The unit of production method attempts to recognize depreciation based on the actual wear and tear of the fixed asset on the balance sheet. The asset is depreciated based on its actual utilization and in terms of what? Its remaining capacity. So what are we saying? You charge depreciation based on units you produce, based on usage of the machine. The more you use the machine, the more you charge, or the higher the depreciation for that machine. Now the step to calculate what depreciation using the word unit of production method. So first of all, you estimate the useful life of the fixed asset in terms of what number of units produced rather than what in terms of years. You say, okay, this machine I will buy now. Let's say you buy a block molding machine. You say, okay, this machine, before we sell it, before it becomes old, how many blocks can we produce with it? Because okay, we may, from your experience, okay, we may end up producing, let's say, 20 million blocks. That is what? That is your useful life of the machine in terms of what you need to reproduce. You have to make the estimate. Okay, this machine will produce 1 million blocks or 20 million blocks. That's the first thing you do. Then subtract the estimated salvage value. That is the value remaining at the end of the year, at the end of the fixed asset useful life assumption from the purchase price of the fixed asset. You say, okay, this asset, after it produces this 20 million blocks, what will be the value of that machine? So if you have it, what you subtract it from what the cost of the machine. What is how much do you buy the machine? Okay, next thing is what? How much or how many blocks will this machine produce? Then what will be the useful life of the machine after producing the number of blocks we estimated? Number three is what? You divide the estimated production capacity from the cost basis of the fixed asset, net of what salvage value assumption, which is what is all in the depreciation per unit of the production. So what we do is what? You now look at, okay, this is the cost of the machine minus what would be the scrap value of the machine at the end of the production period, or end of the number of units that you will produce. Let's say you will produce 20 million and the machine will be, let's say, 1 million, and then you buy the machine, you buy the machine for 20 million. You said 20 million minus, okay, You bought the machine, let's say 5 million. 5 million, and then you say the machine will last for, let's say we produce 20 million units. You now say, okay, um 5 million, the cost of the machine, minus this the use the scrap value of the machine. That is at the end of the production, how many units and how much the value of the machine. Let's say 1 million. Let's say 20 million minus 1 million. That will give you 4 million. Then divide by total number of what units you produce. And that's okay. 4 million divided by 20 million. That will give you what? The units, the division per unit of any of the item of the product. If you say if you have like this, let's do it practically. Let's assume we have let's assume we have, let me just um let's say we say cost of the machine, the cost of the machine. Let's say you bought it at 5 million. Uh-huh. And then your scrap value or residual value, that is, the machine will be valued at, let's say, 1 million. And production capacity, let's say it can produce up to 20 million blocks. That is it. Now, if we want to know how much is depreciation per unit, we'll now say, you now say 5 million, 5 million minus 1 million divided by 20 million. That is total capacity of the machine. Of course, you have 4 million divided by 20 million. Whatever you get will now be what? Your depreciation per unit. That's what we're talking about here. So the next thing is what? Step 4 says what? The depreciation expense recorded in the accounting period is the product of what? The number of units produced and then the rate of what? Depreciation per unit. So if you have, let's say we said 4 million divided by 20. Let's do it. Let me just do it practically. Let's say we have 4 divided by 20. 4 million divided by 20 million. Of course, you have 0.2. So we have 0.2 as what? Depreciation per unit. And give us 0.2 million as what? Depreciation per unit. Now, if assuming in the year 2022, we produce 10,000 units. So what do? We get our depreciation, will now say 10,000 times the depreciation per unit times 0.2. 0.2. That will give us how much? Give us about 20 or 2,000 or so. That will be what? That will be our depreciation for that year. So, in a nutshell, when you're using the production unit method, you look at the cost of the machine first, and then you now say, okay, what is the capacity of the machine? How many can the machine produce? Get the value, the figure, and keep, and then what will be the scrap value, or what will be the residual value of the machine after producing the unit you've estimated? And you do it. You get what? Depreciation per unit. and then keep it. Then each year the machine produce, you take this unit and multiply by the quantity of production for that year, and that gives you what? Your depreciation for that year. That gives you your depreciation for the year. Now look at it here. The formula is given to you here. It says cost of fixed asset minus salvage value divided by estimated capacity of total unit produced. The capacity, that's what we did here. That is the cost of the fixed asset minus scrap value of 1 million divided by capacity 20 million. We got 0.2. Now to get what we said, the total unit produced, which is we said is what is 10,000 units, and then multiply by what? By the we multiply by the unit 0.2 is what estimated is capacity divided by this, multiply by what actual unit that you produce, which is what say 10,000 multiplied by 0.2. We'll do this, we've got 0.2 per unit. That is our rate of utilization. So if we produce 10,000 in the actual unit multiplied by what we get as what as the per unit amount. That's what this one is saying. Now, let's look at this example. Very simple. So suppose a manufacturing company is tracking its precision expense under the unit of production method. At the end of fiscal year 2020, company purchased a fixed asset, that is a capital expenditure, CapEx, for 250 million. According to the management, the fixed asset has an estimation salary value of 50 million, then and total production capacity, that is the estimated number of total production unit is what? Is estimated at what? 400 million. So this is just what we're just treated here. Let me just clean this one and then see how we can solve this one. So we have cost of the machine. From the question here, we have cost of the machine is equal to 250 million. That's capital expenditure, CapEx. And we have the scrap value or salvage value or residual value, salvage value of value this, don't mind my handwriting, is 50 million. This is also a million. And then production capacity, that is the machine will be able to produce a total of 400 million. 400 million. 400 million. Now, to calculate our decision, of course, we say to what? We say the cost minus salvage value divided by production capacity. So for the question, we have 250 million, 50 million minus 50 million divided by 400 million. Of course, 250 minus 50 million it will give us 200 million. 100 million divided by 400 million. Now, we will divide that, we get as 200 million divided by 400 million as 400, we get 0.5. That will give us 0.5 million. That is every unit produced, we're going to charge 0.5 million as what? Depreciation rate, depreciation per unit. Let's go ahead and see. You can all see it from the working here. So cost of fixed asset is what? 250 million. Average values of fixed asset is what? 50 million. Estimated production unit is what? 400 total units. So we say, okay, 250 million, which is this one, minus 50 million, which is this one, divided by 400 units, which is this one, and then we've got what? 0.5. Of course, this is 0.5. Now, each unit produced depreciates the fixed asset by what? 0.5. So this is what we use. Now, if the business or the company now decide to say, okay, or when they produce it, if they produce, now if they produce, they produce 1 million, let's say 1 million, 1 million, 1 million units for a particular year. 1 million units for a particular year. So let's say this is 2022. They produce 1 million units. So in our P&L, account, of course, we have depreciation of this fixed asset. It will be what? Let me just do it. We just said 1 million multiplied by 0.5. That will give us what? Depreciation of fixed assets. Let's say of fixed assets. Fixed assets. That is 1 million multiplied by 0.5 give us what? Give us 500,000 as depreciation for that year. Now, if they produce, let's say the following year they produce 2020, 2023, they produce, let's say 2 million units were produced. So for 2023, you will now have depreciation of that fixed asset. What you do is say, okay, the unit is what? 200 unit multiplied by what? Depreciation per unit, which is 0.5. That will give us what? Give us 1 million. That's how you go about it. Now, this is just what I just explained now. Let's say if we assume that in 2021, total of 20 million units were produced, we can arrive at the depreciation expense by multiplying our unit of production rate by the what? Actual number of units produced. So we say unit of production depreciation expense equals to 0.5 multiplied by 20 million, give us 10 million, which is half. Then in closing, the estimated depreciation expense calculated as well as 10 million for fiscal year 2021. As simple as that. Now, this is what I was just trying to explain, accounting for depreciation. How do we show it in the books? Even though I've explained this one, let me just go ahead and then go through the notes for clarity purpose. Accounting for depreciation. Now, this is after calculating depreciation charge for the accounting year, you must record the amount in the books of account. It is important for you to remember that what the process of making allowance for depreciation is charging to revenue the cost of what the non-current asset consumed during the accounting period. This therefore means that depreciation is a revenue expenditure, and such must be what recorded in the same manner that accountant records normal business expenses. This is what I just explained, not quite long. So the same way you treat other business expenses is the same way you treat depreciation. Same way you treat depreciation. Now we have the double entry. Double entry method of recording depreciation expense in the book of account is as follows. First of all, depreciation expense charge for the year. What do? You debit depreciation account and then create a accumulated depreciation account. And when you first charge, then second thing is what at the end of the year or at any time during the year when all ledgers accounts are closed to prepare the financial statement, what do? You will debit the P&L account and then credit depreciation account. I've just explained this one. Let me just do a small illustration. Let's see whether we have an example that we will look at. Let's see what an example that we look at. We have this illustration. I said on January 1st, 2018, Murphy Drake Nigeria Limited purchased equipment for 800,000 naira. It is the policy of the company to depreciate all assets or all equipment at 20% per annum using the reducing balance method. We are required to record the above on the listed ledger account for the year ending 31st December 2028, 2018, 2019, 2020, 2021, and 2022. We'll show it how it will be shown in the equipment account, and then we have a depreciation account, and equipment, then we have depreciation expense account. Then the third one is what? The profit or loss account, the extract only. Then we'll talk about what? The statement of financial position, that is what? The balance sheet as at 2021, 2018 to 2022. This was a question that we look at how these things are treated. Now we have our table, just like we did in our previous example. We have this table. So we said 2020, yes, and what? 2018, 2019, 2020, 2021, 2022. And what is the carrying amount at the beginning of the year is what? 800,000 naira. Now we have the rate is what? Is given as 20%. For the year, we have now say 20% of 800,000 is what? 160. Let's say 800,000 minus 160 will give you what? 640. This will become our contribution for the year. The 2019 is 640 here becomes an opening balance of what? 640 here. You now multiply it by 20%, you have 128. That's 640 minus 128, you get 5112. That's it, 160 plus 128 gives you 288. And this 512 become the opening balance for 2020. You still multiply 20% on it, you have 104, 102, 400. Subtracting from this, you get 409, 600. You now multiply, you add this 102, 400 plus 288, you get 390, 400. And this one becomes the opening or carrying at the beginning. 2021, 409, 600, multiply 20% of it, you get 81, 920. Then you subtract 81, 920 from 409, 600, you get 327, 680. Now, you now add 390, 400 plus 81, 920, give you 472, 320. And this 327, 620 becomes your opening balance for the year 2022. You now charge 20% on it. You have 20% of 327, 680, you get 65, 65,536. Then you now say 327,680 minus 65,536, you get 262,000, 144,000, and 44 naira. Then you now say 472,320 plus 65,536, you get 537,856. That is what the workings. And we are going to show it what? We're going to show it in this account. The first one is what? Equipment account. And this equipment account for the year 2018, in particular is what? Bank. What's the cost of the machine? It was 800,000, right? So that's January, and then December, the same word, balance carried down 800,000 naira. Then the same 2019, balance brought down 800,000 naira. Balance carried down 800,000 naira. Just like balance, the same value coming down, carried down, up, I mean, brought down, carried down, brought down, carried down. That's how you show it in the machine. The asset, equipment account. Because this asset was bought in 2019 and says bam, 800,000 naira with it 2018, sorry, 2018, the balance carried down will be 800,000 naira. Then the next year will be what? 2019, January. It becomes the balance brought down of 800,000 naira. Then the next date will be, the last day of the year will be 31st December 2019. Balance carried down 800,000. The next date will be 1st January 2020. Now be balance brought down 800,000 naira. Then the last date of the year 2020 is 31st December 2020. Balance carried down 800 naira. Then the next day will be 1st January 2021. Balance brought down 800,000. The last day of the year 31st December 2021. Balance carried down 800,000. Then the same thing till what? The last day of January 2022. Balance carried down 800,000. Then balance brought down to December. The balance brought down is 800,000. Then balance brought carried down is 800,000. That is the first thing you do. Show it in the equipment account. That is what. The next one is what? How do we show it in the cumulated depreciation on equipment? Now look at it here. For year one, we have date is 2018 December. Balance carried down is what? 160. Now, first of all, depreciation is what is always on the credit side. Look at it here. December 2018, depreciation expenses for the year is what? Is 160. 160 was charged for that year. Then the same December, our balance carried down is what? 160. Then 2019, the balance brought down is what? 160. Then how much was charged for 2019? Of course, it is 128. Let me go back so you can see. 2019 is 128. 2020 is 102, 400. 2021 is 89, 920, 81, 920. And then 2022 is 65, 535, 536. That's what we're doing here. So this is the balance brought down from 2018, at least for the year. When they add this 160 plus 128, it gives you 288. Then the balance brought down, so December 2019 will be balance carried down will be 288. That is this figure. Then the balance brought down will be 288. That is for 2020. And what is the charge for the year? It's 102, 400. When you add 102, 400, you have 390. Then balance carried down 2020 is 390, 400. Then balance brought down as of 2021 January will be 390, 400. Then what is the charge for that year? Is 81, 920. When you add it, you get 472, 320. Balance carried down at December 2021 is 472, 320. Then balance brought down as of January 2022 is 472, 320. Then what is the charge for the year? Is what? 65, 536. When you add, you get 537,856. Now, if you go back to our table, this is what we got. 537,856 as what accumulated depreciation. That is how you show it what in the account. Made the entry on the credit side, and then the balance card will be on the debit side. Sorry, then the product will be the following day, then the charge for the following that same year, new year. The same thing, you add the previous year, you add the previous year balance, and then the charge for the year, you add together, get it. You go, then it becomes a balance carried down for that year. And then it becomes balance brought down for the following year. You add the charge for the year, continue till you reach the last day of the last year period. And this is depreciation account. Now, 2019, we have particulars depreciation account. How much was charged 2019? 160,000. Then in the P and account, we have profit and loss as what? 160,000. Then 2019 depreciation account is what? 128. And 2019, the P and L will show as what? 128. 2020, depreciation account will show what will show as 102,400. Then 2020 P&L will show the same figure of 102,400. 2021, we have depreciation will be what 81,920. Then under the P&L account, the same year we have 81,920. And lastly, 2022 depreciation account will show us 65,536 naira. The same thing with P&L account, the same figure. Let's go see. This is how it will be shown in the P&L account. So looking at year 1, 2018, you will show this as what? 160 as what? As your expense under depreciation. If you're treating, if you're handling of you're handling your posting in 2019 account, you will use this figure. If you're treating 2020 accounts, you're going to use this figure 102,400. If you're treating 2021 figure, account, you're going to use 81,920. Lastly, if you're treating the 2022 account, you're going to use 65,536 naira as what tuition charge for that year. The last thing is what? How is it going to show in the profit and loss account? It's going to show in the P&L account. As you can see, 2018 asset is what? Is equipment. What's the cost of the asset as at that date? It was 800,000 naira. What was tuition charge for that year? It was 160,000. We subtract it, then the carrying amount of the labor value will be what? 640. That is in your balance sheet or statement of financial position. You will, for 2028, 2018, you show what? That's how you record it. The cost of the asset is 800 minus tuition of 160 will give you what? 640. This is what your net book value of the asset or the carrying amount of the asset as at 2018. Now, in 2019, the equipment will now be valued at 640, no longer 800 because we have charged tuition for the first year. 640, and then what's the charge for that year? 128,000. We subtract 128 from 640, we get 512,000. Now, this will be shown in what? In our balance sheet. The cost will now be 640 less 128,000 depreciation, and we have an NBV or carrying amount of what? 512,000. Then in 2020, the equipment will now be valued at 512. Then the charge for that year is 102,400. We subtract it from here, you get 409,600. That's how you record it. Then for 2021, you have the value of the machine or the cost of the machine will now be 409,600 minus depreciation for the year, which is 81,920. Then the debt book value will be 327,680. And lastly, in the year 2020, the cost of the machine will now be, or the value of the machine will now be 327,680. Then the charge for the year is what? 65,536 naira. And then you have what? 262,144 as what? As the carrying amount of the equipment. That's how you treat it in what? In the financial statement of financial position or in the balance sheet. Now, apart from depreciation, what we call amortization of fixed assets, we have, sorry, non-current assets or intangible assets. We say the amortization is of intangible asset, also simply known as what? Amortization is a process of what? Expensing the cost of an intangible asset over the projected life of the asset for tax or accounting purposes. Intangible assets such as what? Patent and trademarks are amortized into an expense called amortization. So we have what we call intangible assets. They exist, but you cannot see them, you cannot feel them. Just like we have non-current assets that you can see, you can touch, you can see them. You can see a motor vehicle, you can see plant and machinery, you can see fixtures and fittings, you can see other things. But when we talk about intangible assets, these are what? Assets that exist. You cannot see them, but they exist. Things like what? Things like patents and trademarks. They're what? They are intangible assets. Now, in this, we don't depreciate intangible assets, but what do? We amortize them. We amortize them. So, amortization of intangible asset is a process by which what the cost of such an asset is what incrementally expense or written off over time. Amortization applies to intangible or non-physical asset, while depreciation applies to what? Tangible physical assets. That is different between depreciation and amortization. We have physical and non-physical. Amortization versus depreciation. Assets are used by business to generate revenue and produce income over a period of time. The costs related to the asset are moved into the what? Into an expense account as the useful life of the asset dwindles. By expensing the cost of the asset over a period of time, the company is complying with what? General acceptable accounting principle, which require the matching of revenue with the expense incurred to generate the revenue. I've explained this one. We're trying to work to adhere to the matching concept of matching principle. Now, the tangible assets are expensing using depreciation, and tangible assets are what? Expense through what? Amortization. Depreciation generally includes a salvage value for the physical asset, the value that the asset can be sold for at the end of its useful life. Depreciation does not take into account a salvage value. So that is different. For non-current assets, some of them have what? They have what we call the salvage value or the scrap value. That is the value that you will sell it at the end of its useful life. In the case of intangible asset, you don't have a salvage value. You don't have salvage value. Now, intangible assets are defined as what? Non-current asset with what? Useful life assumption that exceeds 1 year. And this asset may exist for more than 1 year in the business. Now we have the following as what? Example of intangible assets. We have patents, trademarks, copyright, franchise, license. They are what? Identifiable intangible asset. Then we have unidentifiable intangible assets, things like what? Goodwill and brand recognition. You can go Google this one and read about them, please. If you have the time, just go and read about intangible or identifiable intangible asset. Excuse me. And unidentifiable intangible assets. Go, if you have the time, please go and read about them. But I have smaller assets. These are what identifiable intangible assets. This asset that can be separated from one from the company and sold, transferred, licensed, rented, or exchanged. They often have legal rights associated with them. Patent, for example, legal rights granted for an invention, allowing the patent holder exclusive right to use, sell, or license the invention for a certain period, typically 20 years. So a patent is what is a right given to someone who invented something newly. And this right lasts for how many years? For 20 years, exclusively for him alone. Nobody can produce that item or that thing, only him. It's called your patent right. Then we have trademark. These distinctive signed logos or name that define product or services and distinguish them from what competitors. What do you have that differentiate between company A and B? They have what we call, they have their sign, they have the names. When we talk about identity, they are what we known as what trademarks. What about the copyright? That these are what legal protection for original works of authorship, such as what books, music, and are usually lasting a life of what of the author plus 70 years. So this is what mostly given to literature work or music, and the last till you die plus another 70 years. Then franchise, right granted to operate a business using the branding and operational method of another company. Let's assume the Mr. Big we have. Mr. Big can give me a franchise to open a shop, maybe anywhere of my, and then I will use their name, I use their logo, I use everything, and the way they operate is known as what franchise. We have license. These are permission granted to use another company's intellectual property. These are what example of identifiable intangible asset. These are the two assets that you want to amortize. Then we have unidentifiable intangible assets. These are what these are assets that cannot be separated from the company and are often difficult to quantify or value. One, we have goodwill, the excess value paid during the acquisition of the company, reflecting the reputation, customer relationship, and other unidentifiable factors that contribute to the future earning. What is goodwill? For example, if I have a business and I want to sell that business, and then after valuing all the assets, I discover the business will cost will earn me, let's say 20 million. And then someone come and say, you want to buy that business. After valuing the asset, you say, okay, I'll pay additional, let's say 5 million. The 5 million is what is excess to the value of the asset. Why is he paying for that 5 million, additional 5 million? Because of what? Because he will come and meet already established customer relationship. He will come and meet what? He will make use of what? My reputation that I've built over the years. So the person will want to pay more than what the value of the business. What is paying what they go to it. They will have brand recognition. The value derived from what? Customer awareness and trust in brand, leading to what? Customer loyalty and repeat business. So some people would like to take Fanta. It's a brand. Why would they take Fanta? They have their choice. Because because anywhere they go, they know what this is Fanta, and they will become loyal to that product or to that business. Become a loyal customers because of what they recognize the brand. Someone will say, no, what I want is Pepsi. So Pepsi becomes what? A brand to them. So they want to recognize the brand anywhere they go. It's what we call unidentifiable, intangible asset. Then types of amortization we have: the trade line method, the clearing method, annuity method, some of the digit. And then this is an example. Of course, it's the same thing we did. The previous one, the same method that we applied. So the same thing we applied here. This is what the straight line method is equal. Is equal continuously. So we close for tonight. We'll meet in our next class if there's no question. But if you have question, please, the floor is for you. Any question from anyone?
Well, not for now, sir. Thank you very much.
You're welcome.
Just help us post it so we'll go through them.
All right. So I will share the materials on the platform so that you can go through them. If there's anything you don't understand, please just get
Definitely.
in touch with me. Always
Get back.
available.
Okay.
All right. Good night.
Thank
See you.
thank you. Nice. Yeah. Thank you very much.
Bye. Bye.